Hi, welcome to International Finance. I'm Andy Kim. Today we are going to talk about international parity relations, like international interest rate parity, and then purchasing power parity, IRP, PPP, all a lot of P's, right? Um, you gotta pee, go to the toilet first, and then come back here, right? So all the P's over will be here today. And before we move on further, right? You know what happened over the last week? What do I have over here? This is the right gaming headset, right? Why did I purchase this one? To give you some fun time, right? Um, so here's my normal voice, and then here's my
Monster.
Changed voice? Do you see that? Do you like it? Ah, if you don't do your homework well, I'm going to punish you.
Cartoon. This one, right? So another one. Interest rate parity, right? And Fisher effect. All these kind of things we're going to talk about it.
Male.
With different voices, hopefully, maybe. I don't know. Or
Right, so like female voice like this. All kinds of fun. I
can do.
Normal.
Right. So I hope you like it, and for that purpose, I just switched my microphone like this. But I don't know whether this microphone is better than Blue Yeti that I purchased before, right? But let's see, and tell me later. All right. So let's go to right today's lecture, right? Today's lecture, and then how is the international financial market doing these days? Well, if you look at it, right, over the last couple of weeks, it was very turbulent. And I told you before, the world was about, collapsing like crazy in the middle of March, right? And then all of a sudden, with the fiscal policy, fiscal stimulus from the U.S. as well as all around the world, the stock market is performing a lot better than before. Not just better, but if you look at United States market, CNBC, I click it over here, and then U.S. market, please. U.S. market, 7% up in a single day. Wow. I told you 1.5% is one standard deviation, but 7%, crazy, up, right? Crazy up. You see this, right? Over here. Shall I expand this one? Yeah. Yeah, in the middle of March, we were plunging, and then we are getting a little bit halfway back, right? Would it get back to normal level, or would it be hovering around over here, or would we plunge even further? Well, we don't know, okay? We don't know. If I knew the answer, why would I be working here, man? I should be in Wall Street, right? But very, very volatile market. That's what we are experiencing these days. I mean, historic moment. We are sharing that historic moment together, right? And if you look at foreign exchange, shall I go over here? Naver. I'm sorry for those who cannot read Korean language. Maybe I should try something like Bloomberg over here. US dollar, Korean won, chart, exchange rate chart. Okay, how is it doing? 1223.21 Korean won per dollars, right? Thank God I did not change into US dollars before. I was thinking about, wow, at this point, right, when the price of dollar was like hitting 1300 Korean won or something. I was like, do I have to purchase US dollar or something? Okay, but not really. Okay, why is that the case? We have a lot of safety nets these days, right? Currency swap, the relation, the swap, the currency swap. There was set between the Korean Central Bank and the Federal Reserve in the United States. And plus, we also, I mean, that's basically the safety net. And also, we have a lot of, foreign currency reserve, so we don't need to worry about it too much, right? But history or the past experience matters a lot for investors' behavior. The thing is, my kind of older generation people or my father's generation, right? We've experienced the 1998 financial crisis in East Asia, right? If you go back in chapter 1 and 2, you see that financial crisis that happened. At that point, the US dollar, the price of US dollar shot up to about 2,000 Korean won. Okay, 2,000 Korean won per dollar. Can you imagine that? Besides, right before that, US dollar was only 800 Korean won per dollar, right? Can you imagine that either, right? So how much of I mean, it was like almost 2.5 times appreciation of US dollars or depreciation of Korean won in a couple of months, right? Crazy. We call it IMF crisis. What does IMF have to do with this? Well, because the IMF got in and then tried to rescue our Korean government situation, right? That situation. Then the traumatic experience was so much so that every now and then, old generation people say, "Oh, if any other further crisis happens, we should maybe convert our Korean won into US dollars and then to protect our money somehow, or as an investment tool, right?" But we have to know one thing we have to notice is that in the 1998, what was the key issue there? Why did we have such a crisis? Because we did not have enough of foreign currency reserve in the first place, and then the Korean companies, right? All these major corporations, they had so much debt on their balance sheet, and that short-term maturing debt, okay? Which means you have to repay the debt within 1 year, like half of your debt or more than half of your debt. Okay, rolling over 1 year basis is very risky. We call it reinvestment risk or rollover risk, right? Rollover risk, not reinvestment risk. Reinvestment risk is from the other side of the equation, from the investor's perspective, but the rollover risk was there. Okay, so when the Korean won was depreciating, the international investors were pulling out their money and then refused to roll over those debt. Okay, so that was very, very risky. But we learned, okay, over time with this experience, right? Thank God. Instead of forgetting about this kind of things. So afterwards, the Korean government has been accumulating a lot of foreign currency reserves, especially US dollars or SDR in the IMF. I'm going to ask you about SDR in the midterm exam or final exams. And a lot of currency swaps among central banks are happening these days, especially among those major countries like G7 or G20, right? We saw that in the last lecture in US. Not just that, but Korea and China, right? Except Korea and Japan. Come on, Abe. We need something over there, but they don't. They refuse. Okay, just picking on each other like crazy. We just had have a lot of fun doing that. Anyway, so that's what's been going on. So another kind of currency crisis, less likely. Rather, instead of having a currency crisis is like a relative crisis. Relative to the US dollar regime, the currency regimes that use another currency like Korean won suffering from huge economic shock, right? That's currency crisis, relative basis. But this crisis that we are facing right now is like absolute crisis. You and me screwed up together, right? So, in terms of foreign currency, less of a concern these days. And then one of my friends was asking me, do we have to keep our, reduce our bank deposit to right up to the level of 50 million Korean won level, because it is covered by the deposit insurance, right? Deposit insurance, 예금보험, right? So I said, no, you don't have to worry about that right now, I guess, because the financial system itself is not in trouble right now, not in trouble. The real economy is in trouble, right? Instead, the financial systems have been built up so solid, up to a level of saying too much rigid these days. That may be a problem, but depository institutions, we don't have to worry about bank runs these days yet, right? I don't. So I suggested them to, not to pull out your money from the bank. Don't worry about it, okay? Why did they worry about it? Well, in 2008, there were some bank runs indeed, okay? But that was about the financial part of the economy. Here, this time, real economy is in trouble. In that sense, financial market index may be deviating a lot from the fundamentals as well. Not the fundamentals. I should say, I should be careful about it. But the expectation, expectation about the future may be deviating a lot from what we are experiencing right now. Okay, so much so that the price index may be running high, like what you've seen in your Dow Jones index today. Okay, 7% up. Why? Because even though the real economy is suffering like crazy and so much layoff going on, right? It's still the economy expectation about the future seem to be getting better. Let me pull out one thing for you. A couple of things actually. So here is what my friend forwarded to me, right? He was the vice president of a venture company, and then used to work for investment bank before in JP Morgan, and now he forwarded a data chart produced by McKinsey, and McKinsey was forecasting GDP growth of different countries, China, US, and then Eurozone and world, right? Korea, they don't have it, but McKinsey, come on, you guys have to be, paying more attention to Korea, right? And then produce something more like this, right? And what is interesting is this, this year, right? As you see it, the economic growth, right? GDP level will be plunging quickly for the China and the US together, but it will quickly run back, okay, and recover over next year, and then they're anticipating some kind of a how do you say, pressured and then rebounding back, okay, rebounding quickly over the next year, especially for Chinese economy. Right. Maybe this may sound a lot more optimistic, too optimistic, right? But that's some real world analysts and consultants are anticipating for the future. So it's non-trivial. Okay, all this kind of positive expectation will be built into the cash flow of all these companies in the in different countries. So much so that those Dow Jones index and all these kind of things may be shooting up, okay, reflecting all these kind of expectations, right? Now, another thing I have to show you is the US weekly initial jobless claims. What is that about? Well, in the US, right? People work in their workplaces and then sometimes get laid off, unfortunately, and then they get jobless, right? unemployed, then they need to get unemployment insurance, right? They have to claim it to the government that I'm unemployed. Okay. So the Bureau of Labor, 노동부 kind of things, right? In Korean terminology, they collect this data every week, right? They got laid off. Okay, number of layoffs. You can take it that way in this week, week by week. So week by week data is available ever since 1967 in the US, and I want to show you how that has been going on. Okay, let's see. 눈이 침침하세요? Alright, no, come on. So let's run it. Okay, so just do it one more time. Right? So this is their jobless claims. The number has been hovering around 300,000 to 600,000 per week, right? And then you see this graph running up like this to like what? 3 million previously, and then this week 6 million. Again, I show you this, right? Wow. It's just jaw-dropping level of jobless claims. Okay? So many people get unemployed these days. Like this. Right? Crazy. 2 million, 3 million. We thought that maybe, just high enough, but no. The next week, 6.6 million people got laid off. The thing is, as I said before, U.S. labor market is very, very flexible. Quickly laid off when they find no business in temporarily. So they are immediately laying off. But that means the flip side of it is that as the economy takes off, their employment will improve drastically faster, right? In contrast, in Europe, it's slower. They are slow to lay off and slow to rehire. And Asia, no way, come on, right? They are much slower, right? In laying off, and then much slower in rehiring. So the response will be lagged a lot. Okay, I don't know how things work in China. Okay, maybe they are quicker in recovering because if they are exporting a lot of their materials to products to U.S. market. But let's see how things go. So that's basically what's going on, and you will see a lot of investors, individual investors are jumping into the stock market these days. I don't know. I mean,
I would say
Monster.
I warn you not to go into the stock market with borrowed money or anything, right? If you don't know stuff about the stock market, don't go there. Don't invest in what you don't know. That's the basic rule.
anyway, so the thing is, why does the individual investors jump into the stock market these days so much, right? A lot of reasons are there. One of the reasons may be, this is the loss aversion kind of situation. As you saw it before, 6 million people, right, getting laid off, and this kind of crisis for their careers, right? It's in the loss situation. And then so people who faces this kind of losses, they run for chances. They become more risk seeking. Okay, they try to gamble for resurrections for whatever ways, and then stock market may be giving them some tools to do that, right? And also, a lot of you are the students may be jumping into the stock market because you are young blood, right, and overconfident, and then you have also some great sense of buying and selling, like those kind of animal spirit kind of things, right? Is very, very, how do you say, energetic age, right? 20s and 30s of age. They jump into the stock market very frequently. And then another one interesting thing is, well, if you focus on Korean stock market, right? Those individual investors, let's say, who is it? They say 개미 투자자 in Korean terminology, right? Which means individual investors, right? Why ant? Well, because just like ants, we are helpless and we don't have good information in stock market. We are just trading, buying and selling based on our feelings, right? And then hopelessly we are used up, sucked up by those institutional investors, domestic institutions or foreign institutions. So that's why we call it 개미 투자자 in Korean terminology, individual investors. But these days, it seems like individual investors are making a lot of money by jumping into the stock market in Korea. Why is that the case? Well, a lot of explanations can be there, right? But the warning is worth, right? This is short-lived boom time for the individual investors, pretty much. Very dangerous and risky situation. And maybe these ants are lucky this time. Lucky ants, I would say. And number two, interesting phenomena in among Korean individual investors is that their investment is focused on Samsung Electronics. Okay, Samsung Electronics. Why don't they invest in Kospi index, right? Because economic theory says that be a passive investors, right? And instead of actively investing in one single stock or a handful of chosen stocks, invest in market index so that you will be performing just like the average, right? Being average is better than being worse than the average, right? So why don't you invest in Kospi index kind of things? But this time, ants are investing a lot heavily onto Samsung Electronics and Samsung Group companies, right? Why is that the case? So here is one interesting picture that I want to show you. This is a graph generated by Professor 안희준 교수님, right? 안희준 교수님, the super boss, right? Super boss of Korean Finance Academia, right? Why? Because he is the 회장님 or the president of Korean Securities Association, which is thus the most prestigious academic association in Korea. Top conference was organized by this one, right? And then the most prestigious, and he is our one of the most senior guys in SKKU Business School. We should be proud about it, right? 안희준 교수님 just generated one interesting table for us, right? Which is Kospi index chart and the Samsung Electronics price chart, right? Starting base is 2010, right? About 10 years ago, and then up until today. And what you see is that Kospi index, right? I told you before, just invest in Kospi index or, just perform as the average. But unfortunately, this average turns out to be like 개걸음쳐, which means like a sideways walking. 개걸음 means like walking like a crab. Did you ever see crab walking forward? No, they go sideways. 개걸음, right? Like this. So Kospi index, right? They're walking sideways. Interesting thing is Samsung Electronics is one of the component stock in Kospi 200. Okay, one of the Kospi index, and in terms of market cap, this single company takes up about 30% of the whole index, right? So if you look at the blue chart, blue graph, it has been outperforming so much so that if you put $100 in Samsung Electronics in 2010, that must have grown into $250 by now. Jesus, what? Why didn't I invest in Samsung Electronics? Oh my God, right? Yeah. Now, another thing that you can infer from this is, well, the other side of the component stocks, what must have been doing? 빌빌싸 kind of things, right? What means 빌빌싸 means like they have been underperforming like crazy. The remaining guys. I mean, it makes sense, right? To make this average, right? To make this average, given that you have such an outperformer, you can tell pretty much what the other guys were doing, right? So this is the reason why, individual investors are just holding on to Samsung Electronics stock. Okay? This goes against the portfolio theory, right? That's theory. Portfolio theory says what? Don't put all your eggs in one basket. One basket, Samsung Electronics. Well, it doesn't say never put all your eggs in one basket. Just don't put, okay? As a rule, on average, okay? One single interesting case, exceptional case maybe, exceptional, is Samsung Electronics, right? Or Samsung Group. Samsung Electronics is not the only companies that is inside the Kospi index, but Samsung Life Insurance or Securities or SDI or SDS, all these kinds of companies are there, right? Together they will take up more than I think like 40% of Kospi index, right? So focusing on Samsung Group, yeah, quite understandable, given that the other guys were sucking these days over the last 10 years or 20 years. And number three, this is justified, Actually, why was Samsung outperforming like crazy like this? Well, think about your predecessors, your 선배님들, right? Your undergraduate guys who get a job. What's their dream job? Samsung Electronics, right? It's like ExxonMobil in America or some natural resource companies in Latin America. This is the company that has been sucking up all those top talents from Korean Peninsula, fresh rookie graduates from colleges, right? Top quality guys. They were concentrated and they were going to Samsung Electronics over the last 2 decades or more, or 3 decades, okay? So given that you have been working with these top quality guys, top talents, it will be strange if this company was underperforming or average performing, right? They have to be outperforming, right? As long as they were managing these top talents in their average ways, or at least or better than average ways, okay? And number 4, with this one, right? They could have also screwed up the companies, even though they attract those top talents, right? So that's one thing we have to appreciate Samsung's management. Well, that's good. Good job. And then they were not happy with this small domestic market, right? And then they were courageously exploring into the wide world, and then exploring Chinese market as well as, of course, United States market in the first place. Nowadays, they are competing against top guys like Apple or Intel, all these kind of top guys, right? So top 1 or 2, okay? They are getting the Samsung Electronics is now getting the lion's share. No wonder, right? That's why, right? So it's quite understandable. I said, right? Chemies or individual investors investing in these Samsung Electronics companies. But does that justify that you should always put your money in Samsung Electronics going into the future? I want to be careful. Okay, I want to be careful, right, about that. As a rule, okay, in general, it's dangerous to put your all eggs in one basket, Samsung Electronics, right? You never know what kind of alternative candidates are coming up in Kospi index, right? Anyway, so getting back to international parity relations, right? Let's do it, okay? International parity, one of the starting points would be interest rate parity. I'm going to place my picture over here because it makes me better to focus on the camera so that I could hear. Is it right? Yeah. Camera. So that I would be able to look at you. Right. So interest rate parity, we're going to talk about it. There we're going to talk about covered interest arbitrage. Arbitrage, why do we talk about arbitrage? These parity relations we are basing on the arbitrage equilibrium, okay? The 균형 상태, balancing each other out based on arbitrage kind of conditions. If a certain equilibrium does not hold, then there would be some arbitrageurs taking advantage of this kind of disequilibrium and making money until the equilibrium takes place. Okay, disequilibrium, arbitrage profit, and then equilibrium disappears. Disequilibrium disappears, so that you will realize the equilibrium. That's the concept of arbitrage 1. And then number 2 concept of arbitrage is no net cash outflow, which means you take short position in one side and take long position on the other side of the same asset that gives you the same payoff in the future, depending on the state of nature. So that's the concept of arbitrage. Long, short portfolio, or short, long, okay? You take a short position in one side and long position on the other side, which means the net cash flow from your pocket will be 0, okay? And you still, number 3 important thing is your profit coming from the arbitrage would be risk-free, okay? Risk-free profit you lock in, okay? So that's the concept of arbitrage. We're going to come back to this one later. IRP and exchange rate determination. We're going to talk about it, and then currency carry trade will be discussed later. And currency carry trade, well, that's what we called 10 years ago, something called Watanabe 부인's investment. Watanabe, what do you mean? Hajimemashite, Japanese, right? Low interest regime. They borrow money in Japanese yen from Japanese bank and then bring it to South Korea or other Asian countries. That gives you better return, higher returns, right? And then afterwards go back to Japanese bank and then repay the loan, right? You get some profit out of it. Those are the profits taken by Watanabe's wife, kind of, Japanese investors, they say. All right. Reasons for deviations from IRP, interest rate parity. Why do we deviate from it? Transaction cost will be it. Purchasing power parity relations, we're going to talk about it. It's going to be largely about what? Inflation. And then because of the Fisher equation relations, nominal interest rate, well, that has 2 components, which is real interest rate and inflation rate. Okay, in a perfect capital market without any restrictions, right? The real interest rate will be the same all across different countries if, very strong if, okay, if the global capital flow of the world, right, is unrestricted. Okay, unrestricted. We don't see that because the capital flow is perhaps one of the most restricted ones for emerging market countries. Or you talk to Xi Jinping, right? Liberalize the capital flow from China or outside of China or into China so that I can take over your Chinese bank so that it will be Andy Kim's company, Candy Kim's bank. And then Xi Jinping will kill me, right? Because Xi Jinping wants this to be under Chinese control, okay? Because of the national interest, of course. 국익을 보호하기 위해서. Okay, you can do whatever you want. And you talk to Mr. Putin and say what? Bank of Russia. Hey, Andy Kim want to, take over Bank of Russia, and he will kill me. So, no way. The restriction is there. Okay, so this thing does not happen, but in theory exercise, we can think about it. And once we set the real interest rate the same all across different countries, then what makes the interest rate differ, okay, across different countries will be purely the inflation rate difference, right? That's the idea, and this differential inflation rate will be a key driver of foreign exchange rates. Okay, good. Evidence on purchasing power parity, and then we're going to talk about Fisher effect, and then we're going to talk about forecasting foreign exchanges, right? Efficient market hypothesis gets back again here. Oh, the behavioral finance versus rational. Yes, welcome back, right? You talk to me, right? Efficient market hypothesis come, right? That's my subject. And then fundamental approach and technical approaches, and then performance on the forecasters, which sucks, right? In the end, economists in Chicago, right? Chicago economists, they will always say market is efficient. Forecasting, forget about it, right? Today's rate is the best predictor of tomorrow's rate. That will be it, right? So, if you understand all these things, you can skip, right, my material today. Bye-bye. But if you don't understand it, stay with me. Okay, I'm here with you now. All right, let's go. So, interest rate parity defined, right? IRP is no arbitrage condition. Okay, if IRP did not hold, then it would be possible for an astute trader to make unlimited amounts of money exploiting the arbitrage opportunity. Since we don't typically observe persistent arbitrage conditions, we can safely assume that IRP holds most of the time. Or should I say, just a minute,
Most of the time.
Monster.
Yes, most of the time.
Now, good. So IRP, right? Interest rate parity. The formula looks like this. What you have on your left-hand side is your spot exchange rate. Here, based on the textbook, I just use US dollar as a home currency and then British pound as a foreign currency. So dollar to pound spot exchange rate should be equal to forward rate times 1 plus foreign currency interest rate divided by 1 plus domestic currency interest rate. Okay? Now, for example, let's get to this. Okay, example over here. Now, spot exchange rate right now is 1.4 US dollars per pound. 1 year interest rate in the US and that in the UK are 2% and 2.2% respectively. What should be the forward rate that precludes arbitrage opportunity? Basically, I draw two timelines, right? Two timelines like you see over here. One, the bottom one is the home currency, and then the other is a foreign currency, okay? Which one should be home currency and foreign currency? It really depends. Okay, so maybe I just draw two lines for currencies respectively, right? US dollar one and then British pound one. Okay, for the sake of argument over here. Okay, so what do we have? 1 year horizon, and then we have 2 time points, today and then 1 year later. As I said before, forward is a contract between you and the counterparty that you are going to exchange those two currencies at a promised exchange rate that promised right now. Okay, 1 year down the road, but you promise it right now. okay, with your expectation and with his or her expectation, right? So pre-promised exchange rate is forward exchange rate, okay? And then we don't know the forward exchange rate right now, but the information that we got is the interest rate of two different currencies. So US dollar interest rate 1 year, right? It's 2%, and then British pound 2.2%. That you see over here, right? And then you have spot exchange rate, okay? $1.4 per pound. So it's my habit, right, to, how do you say, draw my arrows from the currency in the denominator to the currency in the numerator, okay? So the idea is, as long as you multiply whatever pound amount that you got, right? Pound amount that you got, multiply that guy by this one, you'll get to US dollar. That's why I just make it a habit to draw my arrow in this direction. Okay, it does not mean that you will convert your money into this fixed direction from pound to US dollars no matter what. No. Okay, it's just my habit, right? And then whether I would convert from US dollar to British pound or the other way, we don't know, okay? So stay clear of that. Anyway, so exchange rate is there. Forward rate, we don't know, okay? Forward rate, we don't know. Let's solve for it, okay? In this picture, you have two possible routes from go to stop, okay? I just draw my picture in a Monopoly kind of game, right? Go to stop. 고스톱, right? 고스톱, 포카치냐? Right. So it's like you start over there, and then after a certain route, and then you get out of it. Okay. So that's go. Should I say instead of stop, like out, in and out kind of things? Whatever. Okay. But there is a, as long as you are studying in Korea, you have to know something about the game called 고스톱. Right? Go stop. Right? Anyway, that's something you can learn with, your friends in Korea. Okay, card game kind of things. 화투. But anyway, so that's that. Now, two routes you can go from go to stop. That's this route or this route. Okay. Both ways should give you the same return. Otherwise, there would be some arbitrage opportunities, right? Some arbitrage opportunities. So, precluding arbitrage opportunity means like preventing any arbitrage opportunities. Okay? So, what is that forward rate that precludes arbitrage opportunities is a valid question. Now, one way, as I said before, is lend money in US dollars and get 2% return. Okay? i.e., 1.02 for every dollar invested. Okay, that's route A. Okay? That's route A. Route B says buy British pound. Okay? In the spot market, and then lend British pound at 2.2% interest rate, and then sell British pound at forward rate, sell forward, and then convert it into US dollars, right? At certain exchange rate. Okay? All right. So that's the basic idea. Let me push escape and see what is here, right over here. So what's that? That is 1.4 US dollar per pound. So you have to use this spot rate, invert it, and multiply it by this. You will get a dollar, the dollar into pound, right? Dollar amount times 1 over 1.4. That's going to be your pound amount. And then multiply it by 1.022. That is British interest accrued. And then once you have that, convert it back into US dollars using this forward exchange rate. Remember, this forward exchange rate was your direct quote. Dollar amount divided by pound. So you got pound, so multiply, simple multiplying, F will give you this result, right? And then you will get dollar amount. So route A versus route B, you will end up with, you have to end up with the same dollar amount. That's the idea, okay? Now, good. Then what? Here, okay, you set up the math, right? Route A, route B. Route A, US dollar amount, route B, okay, dollar amount has to be the same, right? That's the idea of no arbitrage condition, okay? So there, you have only one unknown because you know this guy has to be 2.2% and that guy has to be 2%, right? So you do the math and then you will be able to find forward exchange rate, which is $1.397 per pound. Okay, this guy has to be there, right? Good. Now this is no arbitrage condition, and then you can compare immediately and say whether dollar is in forward discount or premium. Also, that means you can figure out whether British pound is in forward premium or discount. Okay? So what do you find? Well, this tells me that the British pound is in forward discount. Make sense? Forward discount, because the exchange rate is, by forward is lower than the spot exchange rate. So that's something you can think about. F over S minus 1 was a forward premium or discount, right? So that's something you can figure out yourself. Anyway, just a refresher of previous chapter. Interest rate parity example, one more, okay? Here, we are going to use cross exchange, right, between British pound and euro. It's a refresher of what we learned last week, right? Because 80% of the foreign exchange trade is done in US dollar terms, right? We first convert it into US dollars and then convert it into the whatever currency you are interested in. So British pound and euro, we are going to do that. Now, investor has 10,000 euros and faces an interest rate of 5% in that euro zone. And he could invest in Europe and have 10,500 euros in 1 year. Or he could trade his euro into pounds and at the spot exchange rate and invest it in UK at 15.5%. Oh my God. Okay. And then later on, convert it into euro, right? At some forward rate, pre-promised rate. Okay. So, how should that work? Well, first of all, we don't have direct exchange rate between euro and pound, so use cross-currency exchange rate, which is 1.25 euro per pound. How did you calculate that? Well, here is euro per pound, and then, okay, here we split into two terms, and then use mathematicians' favorite technique, which is multiplying and dividing by the same numbers, right? Which is multiplying by 1, okay? And here, what would you play with? US dollars, right? Multiply and divide by the same US dollars. And then, there on the left hand side, that will be the inverse or reciprocal of euro or dollar to euro exchange rate, $1.2 per euro, and you flip it. That's 1 over 1.2. The second term is our what's that? Usual exchange rate between dollar to pound, $1.5 per pound. So multiply these two, you get 1.25 euro per pound. Now, spot exchange rate, got it, happy. Now, the next one is about the forward exchange rate. How do we do that? Well, the next slide, okay? If we invest in Britain, he hedges his exchange rate risk with a short position in a forward contract on the 92.40 pound. His investment will grow too. Okay, so that, what's that? 10,000 euros, you convert it into pound and then grow it at 15.5% interest rate in British Bank, maybe Barclays, maybe HSBC. Okay. Hong Kong Shanghai Bank, how could that be British Bank? Yeah, it is British one, by the way. Anyway, so that will give me 92.40 pounds. The next thing you have to do is convert it into euro at pre-promised rate, which is called forward rate. Okay, then you will have to have identical return as if when you are lending your money at euro interest rate 5%. Okay, so what's that pre-promised rate that equates these two? That's forward rate over here. Okay, 0.88 British pound per euro. Okay, so if you look at my diagram as in the next slide, okay, move on. Yes, all right, it works like this. Here, two timelines, right? Two timelines. One, okay, 1 euro, and the other is British pound. I should have said it this way. Okay, so two timelines like that. Okay, and then so starting point times 0, ending point 1 year later. Okay, and then spot exchange rate, you got 0.8 pound per euro. Why? This is a reciprocal of what we got before. Okay, 1.25 euro per pound. Flip it, 0.8 pound per euro. Okay, always this is going to be confusing, right? And then at the end of the period, okay, at the end of 1 year, what do? Well, you need a forward exchange rate. Okay, just to be consistent, I'm going to use that pound to euro exchange rate over here. We don't know, so I label it as question mark, right? And then initial money that you got is 10,000 euro. You go, and then after 1 year, you get to this stop point over here. Okay, and then whether you go this way, route A, or that way, you should get the same amount of euros. Otherwise, there would be what opportunity? What opportunity? Arbitrage opportunity, right? You need to get the same amount of euro at the end of this point, right? Now, route A is simple, 1.05 euro, right? This one, easy. That way, route B, how does that work? First, convert it into British pound using the cross exchange rate, 1.25. So, 8,000 British pound will be there for you. And 15.5% interest rate. By the way, why did I say holy cow? Because this is very low interest rate regime. Okay, low interest rate regime. Even negative interest rate is going on, and 15.5%. Can you imagine that? Well, don't you think that's what's coming up next year or the year after, right? Or I mean, the central government, right, or the central banks are printing so much money, right, to rescue the whole real economy, okay? So that wouldn't there be some inflation? Okay, some inflation, I say. Some, right, that sum is very important. Anyway, so 15.5%, okay? interest rate. That then at the end of the period you will get 92.40 British pounds. That's not the end. You have to convert it back into euros using forward exchange rate. Okay, we just don't know how much that will be, but one thing for sure is that we have to preclude any arbitrage opportunities, which means once you convert it, that has to be 10,500 euros. Okay, we have to equate those two things, and then we got only one unknown over here. That's F. That's 0.88 pound per euro. That has to be your forward exchange rate. All right. So that's how it works. And then why IRP holds? Okay, why should IRP holds? Suppose, okay, that the 1 year forward rate was tiny bit too low at 0.8799 cents. 0.8799 pound per euro. Okay, slightly smaller than 0.88. Okay. An astute trader would move quickly to do the following. Okay, essentially arbitrageurs get in there and will do the following. One, borrow 1 million euro at the euro interest rate 5%. Okay, and trade this 1 million euro for 800,000 British pound at the spot exchange rate. And now what do we do? Invest this British pound at 15.5% interest rate in Barclays or whatever. Okay, enter into a short position in a 1 year forward contract on 924,000 pounds at this one, the given forward rate, which is different from 0.88. Okay, so use this one. Okay. And then in 1 year, he has a cash inflow of this amount. Once you divide this guy by 0.8799, you will get this much. All right, from the forward contract. And now he owes what? 1,050,000 euros. So that he has to repay this amount to European bank, right? Maybe that was Deutsche Bank or whatever. After repaying those, how much would you get? 119.33 euros in your pocket. Okay, so taking afterwards, this is the arbitrage profit that you can imagine if the forward exchange rate is not 0.88 but 0.8799, slightly deviating from that exchange rate that you calculated before. Arbitrage opportunity is there, right? And then let's move down over here. Yeah, in a pictorial diagram, right? So you have, right, what will be the arbitrageur's opportunity, right? How would he materialize this arbitrage opportunity? Well, borrow and lend at the same time. I told you before, long short position at the same time so that your net cash outflow will be zero in the beginning, okay? In the beginning, right? To lend in Britain, you need some money beforehand, okay? So to lend this British amount, what would you do? Borrow. Lend and borrow. It's like a long short difference, right? Borrow money in Deutsche Bank, let's say, in the Deutsche Bank in Germany, and Gesundheit, and then what? You borrow at 5% interest rate, and then convert it into British pound using spot exchange rate, and then go to Barclays Bank and lend it at 15.5% rate. Here you are, man. And then later on, you get the British pound amount, 0.924 million pounds, right? And now what do? Convert it into euro at the forward exchange rate that's slightly deviated from what it has to be. So 0.799 exchange rate, and then you get what? More amount of euro than what you should really get with the true or forward exchange rate that you calculated before. So now you have to repay that 105, okay, we'll say 1.05 million euros, and then leftover has to be your arbitrage profit. Here I calculated as 120 euros, which is, essentially the same as this guy. Just we have a rounding errors issue, right? But yeah, it's basically what I'm saying over there. And then on the other hand, suppose that the 1 year forward rate was tiny bit too high at 0.8801 pound per euro, okay, instead of 0.88, okay. Notice that small tiny amount of difference, right? And this is why actually the small tiny amount of difference gives you small tiny amount of arbitrage profit. Out of 1 million euros, you got 120 euros worth of arbitrage profit, right? So 1000분의 1 kind of, 0.001% profit. Anyway, so astute trader would move quickly to what? Borrow 800 pound at 15.5 percentage point and trade 800,000 pound for 1 million euro at spot rate and invest 1 million at 5% and enter into a long position in a 1 year forward contract on 924,000 pound at 0.8801 pound per euro. Okay, and in 1 year he has a cash outflow of 105 what's that, 1,050,000 euro from the forward contract and owes 924,000 pound, and risk-free arbitrage profit will be 119.31. Okay, identical to the ones that you had before, right? Now in pictorial diagram it will look like this, right? So let's leave euro line and then pound line the same, but the go and stop point will be different this time. Okay, because here you'll have to start with pound in the first place, right? Now what do you do? Well, borrow $0.8 million to go into that arbitrage opportunity, right? Borrow and lend at the same time, long short position, no net cash flow out, okay, no net cash flow in the beginning. Okay, that's the beauty of arbitrage, I guess. So what do we do? Now borrow 0.8 million pound at 15.5% interest rate, so you have to repay $0.92 million at the end. Okay, and then here you convert it into euro at this 0.8 exchange rate, and then once you get the euro 1 million, right, using this, then lend it to any German bank, right, at 5% rate, and then at the end of the period you will get the money out, okay, 1.05 million euros, and then there's a choice, right? There's a choice. One way is to convert everything into British pound and then repay it. Okay, repay 0.924 million pounds and then get the arbitrage profit in British pound. Okay, that's one way. The other way is just repay. Okay, just convert the necessary amount to exactly meet the repayment. And then the remaining amount, keep it in your pocket. Okay, so how much do we need to exactly repay this debt amount that you got? 0.924 million pound. To take care of that debt, you just have to convert 1.049881 million euros, or 1,049,881 euros, and convert it into pound. And then as you see, the amount that you have to convert is smaller than what you got already. Okay, the difference is 119 euros, the arbitrage profit. Okay, so that's the idea. Okay, and then which one do you have to do? Do I have to convert everything, or do I have to partially convert? Okay, that depends on the context of the problem, right? Would you like to get your arbitrage profit in euros or in British pounds, right? Depending on your preference or the questions, you have to be able to flex around, right? Okay, that's that. Then let's move on to the next slide. Yes. So dollar cash flows to an arbitrage portfolio, right? Transactions. One is borrow in the US, and then 2, lend in the UK, and then 3, sell the British pound receivable forward, and then think about the net cash flow at each time point, like this. Cash flow 0 and cash flow 1. So transactions in cash flow 0, okay, at time point 0, borrow and lend at the same time in 2 different countries, right? Long short position, okay? So the net cash flow will be 0. Net cash flow will be 0. This guy cancels each other out, okay? And then at the end of the period, what you get, well, you have to repay what you owe, okay? And then get the money from the borrowers in the other country, and then convert using the forward exchange rate, and then think about the gains that you got, net cash flow, okay? Will be this, right? All right, and then the forward exchange rate is the rate that equates these two, okay? 0. This has to be 0. Net cash flow has to be 0. Otherwise, there would be arbitrage opportunities. So this is an arbitrage equilibrium. Okay, that precludes an equilibrium that precludes any arbitrage opportunities. So net cash flow has to be 0 in both time point, right? So that's this idea, and then right. Okay. That's one period IRP, interest rate parity, right? Can we have some more fun doing it for multiple periods, right? Yeah, why not? Yeah. So here we do multiple period, a 2 period IRP to calculate the 2-year forward rate compound for interest rate for 2 years, right? It works like this. The same euro per pound relation that we studied before in the example, right? Second example. And then 5% interest rate or per year over the next 2 years, right? In Eurozone, and then 15.5% interest rate in British pound zone, okay? In Britain, right? Then the 2 period IRP also has to hold. That's the idea. So in my style of diagram, it looks like this, right? So Andy diagram, right? Interest rate parity. Well, we just have 2 periods instead of 2 periods instead of 1 period, right? And then you start with euro, 1 million euro, right? And then whether you go into euro way or go into spot exchange, then into British pound ways, and then can come back through forward exchange rate, okay? you'll have to end up with the same amount of euro. That's the arbitrage equilibrium condition over here. All right, so you just have to compound over 2 periods instead of just 1 period. Okay, that's it, nothing more. Don't touch the exchange rate, spot exchange rate. Nah, it's determined in the market right now. Forward exchange rate, instead of 1 period, just have to be 2 periods, right? This exchange rate in 2 years has to equate the 2 cash flows that I told you before, right? So once you converted your amount, okay, or borrow 1 million from Deutsche Bank, let's say, and then after 2 years you have to repay 1.1025 million euros because 5% interest rate compounded over that 2 years horizon. And then this is the amount that you owe. The other way around cash is your lending, because here you borrowed, right? In Europe, you have to lend over here, okay? Long short again, arbitrage. Now for that part, you have to convert it into British pound using the spot rate, and then lend it at I don't know, Lloyd's Bank in London, okay? And then over 2 years, how much would you get? 1.067 million pound, because we are compounding at this 15.5% interest rate. 2 years. Now, what should be your forward exchange rate? Well, that has to be the exchange rate that equates this British pound amount with 1.1 million euros that you see over here. So what should that be? 0.968. 0.968 should be the forward exchange rate. Okay, good. Let's move on. Right, multi-year interest rate parity. Well, here is mathematically how things work, right? Instead of just 1 period interest relation, you have 2 periods interest relations over here, compounded. Okay, the numerator and denominator compounded at the same time. Make sense? All right, so that's that, right? Right. IRP even more carefully defined. Interest rate parity is a no arbitrage condition that suggests that forward exchange rates are defined by today's spot exchange rates, grossed up and down by the future value interest factors. Now, in our example with a spot rate of 0.8 pound per euro, interest rate parity says that the n-year future exchange rate that prevails today must be like this. Spot exchange rate times this 1 plus interest of your foreign currency and domestic currency to the power of n. Okay, to the power of n. That should be your n period forward exchange rate, n-year forward exchange rate. Okay. Notice that we increased the pounds in spot rate at interest rate in pound, and the euro in the spot rate by interest rate in euro to find the forward rate. Now, currency carry trade is there, right? Currency carry trade. Well, currency carry trade involves buying a currency that has high rate of interest and funding the purchase by borrowing in currency with low rates in interest without any hedging. Okay, it's again long short position, but the way you borrowed, okay, the interest rate of the currency that you borrowed is so low that you can take advantage of it, okay, by lending it at higher interest rate countries and then getting back. The carry trade is profitable as long as the interest rate differential is greater than the appreciation of funding currency against the investment currency. right? So the interest rate gap has to be big enough to justify this kind of trade, carry trade relations, right? Right, good. Suppose 1-year borrowing rate in dollars is 2.01%. The 1-year lending rate in pounds is 1%, very low. Is it very low compared to today's reality? Not, but a couple of years ago it was very low. The direct spot ask exchange rate is $1.25 per pound. A trader who borrows 1 million will owe um, 1.0201 million pound or dollars, right? I'm sorry. Okay, this is dollars. Right, 1,020,100 dollars, right? In 1 year. Trading 1 million for pounds today at the spot exchange rate generates 800,000 British pound. Now, using this 800 British pound, invest it for 1 year at 1% yield. And that will give me 808,000 British pound. The currency carry trade will be profitable if the spot bid rate prevailing in 1 year is high enough that his 808,000 pound will sell for at least 1,020,100 dollars, enough to repay this debt. No less expensive than this one, okay? 1.2625 dollar per pound in exchange rate, okay? In 360, that means 1 year from now. Here we use bond market convention. What is that? Well, spot exchange rate in 1 year, 360 days. Bond market convention, 1 year equals 360 days only. Okay, for simplicity's sake. Because, 365 days is mathematically complicated to compute all these things, right? So that's one convention that we just use. Anyway, so the interest rate spread and exchange rate changes. 6 months carry trade periods for Australian dollars and Japanese yen pair, right? So what you see is over the last decades, right, or 2 or 3 decades, there has been a lot of carry trades using Japanese yen, because Japanese, I told you before, in Japan, they were experiencing lost decades. Ever since early 1990s, right? They've been suffering from economic recession that never comes back. So much so that they had to invite Abe to screw up even more. But anyway, 1990s. So what they did was lowering the interest like crazy in the negative interest rate regime, which means in negative interest means like you borrow money and I will pay you too. Okay. So why don't I borrow it, right? And then invest it in Australian dollars or something, right? So Watanabe wives, right? Those kind of trading was there, right? And then interest rate spread between these two regimes is shown over here, and then exchange rate between these two currencies are shown, right? Anyway, now the reasons for deviations from IRP, right? Well, sometimes those forward exchange rate and spot exchange rate, this equation does not hold strictly.
Right, of course. The IRP does not always hold, right? Don't get misled, bud, okay? Don't get misled. There may be some reason why the forward rate may deviate from what it should be based on your calculation. Why? Why could there be some deviation? Because number one, there could be some natural interest rate difference between the borrowing rate and lending rate. Okay, transaction cost is there. One of the transaction costs is the borrowing and lending rate spread. Okay, interest rate available to an arbitrageur for borrowing borrowing rate may exceed the rate he can lend IL, right? I'm not talking about I to the power of B. I의 b제곱, no way. I to the power of L, no way. Okay? So, borrowing and lending rate difference can be one reason. Another reason is bid-ask spread. Okay, the bid-ask spread always bothers you, but yeah, the bid-ask spread. We saw it before, right? In forward market or spot exchange rate market, the bid-ask spread. What did I say? This is the fee that the market maker or the dealer in the middle, right? They earn, right? As just as a working, as a middleman. Okay, brokers, they have to charge bid-ask spread, right? Now, there may be bid-ask spread to overcome, right? This F of B, bid price, right? There may be some bid-ask spread to overcome in the first place, so that the small, tiny amount of difference may always be there. The gap will be there. Okay, so if you do the math, right, you'll realize a little bit about it, right? Now, the capital controls, right? Capital controls is legal environment restriction, okay? The government sometimes restrict import and exports of money through taxes or outright bans. I told you about Xi Jinping, don't piss off the Xi Jinping, right? Or Putin, right? The Putin big brother, Russia. You want to take over a Russian bank? You talk to me at my gunpoint, kind of things, right? Alright, to give you some idea about this unprofitable arbitrage situation, right? I want to introduce the IRP line over here, IRP line, interest rate parity line. That is, what is it? Well, that shows the relation between the forward rate to spot exchange rate differential with respect to the interest rate differences, right? Now, the idea is the forward rate, okay, being greater than your spot exchange rate or not, is really directly related to the interest rate differential between your home currency and the foreign currency that you are interested in, alright? So how does that work? Well, it gets back to this idea, okay? Spot exchange rate and forward exchange rate like this. We're going to get to F minus S over S, right? And we want to show this is your home currency, your foreign currency interest rate differentials, right? We want to show this. How? Well, let's look at this one over here. This tells me that S times 1 plus your home currency interest rate should be forward rate of 1 plus foreign currencies interest rate. Make sense? Now, what do we do? Well, place it, take this guy to the other side of the equation. 0 has to be equal to F plus F I pound minus S I dollar. Make sense? Good. Then, here we add and subtract the same thing, which is your S I to the pound S I pound. Can you see it? Yeah, like that. Over here we have F minus S, right? So this guy is done, and the other guys, right? Minus S, and then I slash S, I, like this. Make sense? Alright, so things are getting closer to what we intend to. So gather together the like terms one more time. These two guys, right? Here, F minus S, and then 1 plus I interest rate of pound should be S I pound. Okay? These two guys will be equal, and then we send this guy to the other side of the equation, which means S F minus S, and then will be equal to I dollar I pound 1 plus I pound. Make sense? Like this? Alright. Then we are very close to this one except for this guy. Okay? But usually the interest rate will be low so that this guy will be almost 1 anyway. Right? That's our, how do you say, just we are ignoring, okay, this magnitude. Once we ignore it to be very small, then we have this relation, okay, from here to there. Make sense? So, important intuition is that your forward rate differential from your spot exchange rate should be mostly explained by, or should be exactly the same as, the interest rate differentials between the two different currencies. Okay? Now, so much so that there should be 45 degrees line if we plot this one as y and that one as x in your axis, right? So that's what you see in this diagram. Yes. IRP line. Alright? Yeah, right. So, and then based on it, what's the belt that you see? Gray area. Well, that's the bid-ask spread range, okay, for forward and then spot exchange bid-ask price may be deviating, will be always, there will be different from the price itself, right? And also there should be some deviation slightly coming from the interest rate differentials because of the, borrowing rate and lending rate difference, the spread, okay, will be there. So to the extent that those transaction costs justify, okay, there will be some deviations from this IRP line, okay, so much so that if you find any forward exchange and then spot exchange, right, given your interest rate differentials, the point, if you happen to end up in point D like this, is it a good arbitrage opportunity? And the answer is no. After netting out those transaction costs, nothing much, right? It's not worth trying it. You will get, you will spend too much money for your cost. On the other hand, if you found out yourself to be on this C point or somewhere outside this belt, right? Then you have significant arbitrage opportunities. Over here, over there, okay? Arbitrage opportunities. So that's the basic idea, okay? Small differential, right? Difference does not tell you to trade and do the arbitrage trading, okay?